$295,000 was Cotality's average accumulated equity for a borrower with a mortgage at the end of 2025. At a 4% withdrawal rate, that amount represents $11,800 a year of portfolio income. Cotality's newer first quarter 2026 update raised the benchmark to $310,500 or $12,420 a year at 4%. Those are averages for borrowers who still have mortgages, not averages for paid-off homes. They establish the scale of wealth concentrated behind one residential address. And once your mortgage reaches zero, a forged real estate document can place that value behind a public record you did not authorize. The useful response is often free and takes about 5 minutes. Many county recorders, registers of deeds, and clerks offer an alert that notifies you when a deed, mortgage, lien, or other matching document gets recorded under your name or against your property. The alert does not block the filing, authenticate your signature, or erase fraud. It closes the dangerous gap between the document entering the record and you discovering it. That distinction matters because a paid-off home feels like the safest asset you own. The monthly payment is gone. The lender releases its lien. Your housing cost drops, your cash flow improves, and several decades of disciplined payments become equity. Your brain interprets that milestone as completion. The paperwork interprets it differently. The bank did not suddenly hand you ownership when the final payment cleared. In the ordinary modern mortgage arrangement, with terminology varying by state, you were already the owner named on the deed. The lender held a security interest in the property, documented through a mortgage or deed of trust. That lien gave the lender a claim against the home if you stop paying. Payoff removes the debt and causes that lien to be released or reconveyed. The deed layer remains. The county's land records remain. Other documents can still be submitted for recording. The change is not that your title has become unprotected for the first time. The change is that the property now presents a cleaner financial target. There may be substantial equity with no existing mortgage lien complicating an attempted sale or new loan, and the old lender no longer has money secured by that property. That lender was never a full-time fraud monitor checking every county filing for your benefit. It did, however, have a financial interest tied to the address. Once its balance reaches zero, that financial interest ends. Your home remains in a public recording system, but the party being paid every month has left the relationship. That is a surprisingly large category of property. Census Bureau data for 2024 showed about 35 million owner-occupied homes were owned free and clear. That was 40.3% of owner-occupied homes, compared with roughly 32.8% in 2010. The FBI has specifically identified properties without a mortgage or other lien among the targets criminals search for in public records. In June of 2026, the FBI again advised property owners to check whether their local recorder, register of deeds, appraisal district, or clerk offers automated document notifications. A quick note here. I built a digital book called the Exit Code for people translating assets such as home equity and investment accounts into a retirement date without pretending every asset carries the same risk. It is available through the link in the description. By the way, clicking subscribe helps a lot, so thanks to everyone clicking it. Now we need to look at the document, because the absurd part is how ordinary it appears. The document is often a quitclaim deed. A legitimate quitclaim deed has normal uses. Families use one to transfer property between relatives. Former spouses may use one after a divorce. Owners use them when moving property into or out of certain legal arrangements. The deed transfers whatever ownership interest the signer has if the signer actually has an interest and has legal authority to convey it. That last part does enormous work. A quitclaim deed generally does not promise that the person signing owns a perfect lien-free title. It does not provide the broad warranties associated with a warranty deed. It purports to convey whatever interest the grantor possesses. That makes the document efficient when everybody involved is legitimate. Efficiency becomes awkward when the signature is not. The operative parts are not mysterious. The document identifies the person supposedly giving up the interest, the person or entity supposedly receiving it, and the property through an address or legal description. It contains a signature and usually an acknowledgement by a notary. State and county requirements differ, and some places require witnesses, preparer information, tax details, identification numbers, or other fields. A fraudster does not need to redesign the land record system. The fraudulent page needs to present itself as an ordinary conveyance. The owner's signature is forged. The notarization may be false, forged, stolen, or improperly obtained. The receiving party may be a person or a company controlled by the people behind the filing. I am deliberately leaving out the methods criminals use to obtain personal information or evade identity checks. You do not need an operating manual to understand the vulnerability. You need to know that one page can contain a false owner signature and still look routine when viewed as an administrative filing. The deed then reaches the county office responsible for land records. Depending on where you live, that office may be called the recorder, register of deeds, clerk, clerk of court, registrar, or something equally thrilling. Its core function is recording and indexing documents. The office checks whether a deed appears to meet the formal recording requirements in that jurisdiction. It may verify that required names, addresses, acknowledgments, fees, and property information are present. What it generally does not do is conduct a forensic investigation into every signature and notary stamp. Hillsborough County's own guidance explains that its clerk verifies whether a deed meets Florida's requirements on its face, but the office lacks legal authority to determine whether signatures were forged. Other county recorders describe the function as ministerial. The clerk receives recordable documents and places them into the public index according to law. That is not laziness. A recording office processes a vast flow of deeds, mortgages, releases, liens, easements, court documents, and other instruments. Turning every filing into a criminal investigation would paralyze ordinary property transactions. The result is mildly ridiculous. The public relies on the record because documents are recorded there, while the recorder cannot treat every apparently valid document as a potential crime scene. Once the forged deed is indexed, two versions of reality exist. In lawful reality, you did not sign anything. A forged deed generally does not magically defeat the true owner's legal rights. Recording a document is not the same as a court proving that the conveyance was valid. The recorded appearance is different. A search may now display a document purporting to transfer your interest to somebody else. Anyone examining the chain of title has to deal with that filing. Your title may be clouded even when the underlying deed is void or fraudulent. That cloud is the useful part for the criminal. The goal is not normally to arrive with a moving truck and argue about your couch. The goal is to turn apparent control of the property into money before the record is challenged. The FBI describes several possible outcomes. The fraudster may attempt to list and sell the property quickly. They may seek a mortgage, construction loan, refinance, or another loan using the home as collateral. They may attempt to rent it to someone who believes the arrangement is legitimate, shows the mechanism clearly. A fraudster targeted property owned free and clear, prepared deeds with forged owner signatures and a fake notary stamp, recorded them, and used the apparent ownership to obtain fraudulent loans. One recorded deed helped support a construction loan of more than $500,000. That is why the absence of a mortgage can be attractive. An existing lien raises questions. A legitimate lender already has a recorded claim. Sale proceeds would ordinarily need to address that debt. New financing has to account for the existing secured interest. The lien adds friction and another financially motivated institution to the transaction. A mortgage-free record can appear cleaner. There is no old loan waiting to be paid from a sale and no existing mortgage balance consuming the equity. From the fraudster's perspective, your achievement looks like unused collateral. This does not mean every paid-off home is being hunted. Deed fraud remains much less common than credit card fraud, phishing, or ordinary identity theft. Occupied homes can be targeted, but vacant land, empty properties, rentals, homes under renovation, estates, and properties connected to elderly or absentee owners can offer a longer period before somebody notices unusual activity. The risk profile is rare, but severe. A fraudulent charge on a credit card is usually visible in an account you already monitor. A forged deed may not change anything you see during breakfast. Your key still opens the door. Your furniture remains in the same rooms. No mortgage statement arrives because you paid the loan off. You may continue receiving tax bills, maintaining insurance, cutting the grass, and sleeping in the home while a false document exists in another building or database. The controlling variable becomes elapsed time. The clock starts when the document is recorded. It continues while you remain unaware. During that window, the fraudster may try to create additional documents, involve lenders, attract buyers, collect rent, change utilities, or build a more complicated paper trail around the original forgery. The danger is not that recording converts the forged signature into a legitimate one. The danger is that other people can act on the recorded appearance before the true owner challenges it. The national statistics require careful labeling. The FBI's 2025 Internet Crime Report logged 12,368 complaints in the broad real estate category, with reported losses of $275.1 million. That is not a deed fraud count. The real estate category includes other internet-enabled schemes, particularly fraud connected to transactions and payments. The FBI says it does not maintain a clean national statistic solely for quitclaim deed fraud. Anyone presenting the broad total as a precise number of stolen titles is stretching the report past what it says. The industry's claim data gives us a better measure of potential household severity, although it also needs a label. Milliman analyzed 127,228 title insurance claims associated with policies issued over the decade ending in 2022. Fraud and forgery claims produced an average total claim cost of $143,518. Other claims averaged $26,328. The larger number combined average loss payments with the expense of investigating and defending the claim. It is not a prediction that every victim personally loses $143,518. It tells you that fraud and forgery title claims have historically been expensive to resolve, averaging more than 5 times the cost of other claim categories in that study. Put that beside the earlier portfolio number. $143,518 equals more than 12 years of the $11,800 in annual income represented by the year-end equity benchmark at a 4% rate. You can be completely right about ownership and still face a costly correction process. A recorder usually cannot delete a recorded deed because someone calls and says the signature is fake. The office is not a court. Removing or neutralizing a filing may require legal procedures that vary by state, including a civil action to quiet title, a criminal process, a corrective instrument from an authorized party, or a court order declaring the fraudulent document invalid. A quiet title action asks a court to determine ownership and remove competing claims or clouds from the title. Published estimates commonly place a straightforward, uncontested action somewhere around $1,500 to $5,000, often taking several months. A contested dispute involving active defendants, multiple parties, discovery, or trial preparation can exceed $8,000 to $15,000 and continue for more than a year. Those are illustrative ranges, not national price quotes. Court schedules, state law, attorney rates, service requirements, title research, insurance coverage, and the number of people claiming an interest can move the result sharply. The important point is not the estimate, it is the asymmetry. Recording the bad document may be fast. Correcting the public record can require evidence, lawyers, hearings, and patience. A real case in Hillsborough County, Florida, demonstrates both sides of the alert better than any marketing promise. On February 14th, 2024, Michelle Cherry recorded a fraudulent quitclaim deed connected to the Tampa area home of Dreama and Larry Bilby. The owners had become concerned after their security system captured people prowling around the property, which was undergoing work. On the same date, the fraudulent document was recorded. The Bilbys enrolled in Hillsborough County's free property fraud alert program. Within 48 hours, the system notified them that a change connected to their property had entered the official records. They could view the deed and see a stranger's name appearing in the purported transfer. The alert worked quickly. The property was not quickly restored. According to the Hillsborough County Clerk's account, the Bilbys then endured an arduous legal fight lasting about a year and a half before a court order returned the property record to them. On May 27, 2025, Cherry received a 15-year prison sentence for her role in the theft of multiple properties using forged signatures on quitclaim deeds. That case changes the meaning of the alert. It was never a lock on the recorder's door. It did not stop the deed from being submitted, and it did not give the clerk authority to erase the filing when the Bilbies objected. It prevented the false deed from remaining invisible. There are two clocks in deed fraud. The discovery clock measures the period between recording and the lawful owner learning about it. A county notification can sometimes compress that period from months or years into hours or days. The restoration clock begins once the owner knows. That clock may involve law enforcement, legal counsel, an existing title insurer, court filings, negotiations, evidence, and jurisdiction-specific procedures. An alert cannot promise a short restoration clock, but an earlier discovery can reduce the time in which the filing remains uncontested, and additional transactions can be attempted. Traditional retirement planning is excellent at calculating market returns to 2 decimal places. It can model a 4% withdrawal rate, inflation, taxes, and the probability that your portfolio survives 30 years. Then, it may treat the paid-off house as one calm number sitting in the net worth column. County recording risk does not appear in the calculator. Neither does the administrative delay created when a forged page clouds the largest concentrated asset in your household. The spreadsheet can be mathematically elegant while the boring document is doing the actual damage. Knowing the numbers and building a system around them are two different things. That gap is why I created a digital book called The Exit Code, an analysis of 50 years of retirement data distilled into a mathematical framework for exiting the rat race. It examines the 4% trap and the dynamic withdrawal method that replaces a fixed rule when markets, taxes, and real life refuse to cooperate. It also explains the lazy portfolio and the framework that turns a pile of assets into a specific retirement date instead of a vague feeling that you are probably close. You can get it for less than a dinner out through the link in the description. Every year you delay a workable retirement system gives taxes, inflation, and uncertainty another year to compound against you. Protecting the home's record fits the same principle. The asset number matters only when the structure around it works. The county alert structure is refreshingly plain. A local system monitors the information it indexes, commonly an owner's registered name, a business or trust name, a parcel, or a combination supported by that county. When a new document creates a match, the service sends the notification method available there, which may include email, text message, telephone call, or mail. The notification normally identifies enough recording information for you to inspect the official record or contact the office. It does not declare the filing fraudulent. A mortgage satisfaction, legitimate lien release, estate document, refinance, court filing, or document involving another person with the same name may trigger a valid alert. Think of it as an alarm, not a verdict. It does not prevent somebody from presenting a document. It does not verify that every signature is yours. It does not confirm that the notary personally watched you sign. It does not ensure your equity, pay legal expenses, or replace a real estate attorney. It also may not catch every possible document. Some county systems match names, while others attach alerts to parcel information. A document indexed differently, a misspelled name, an unregistered variation, or a filing outside the service's coverage may not create the result you expect. That limitation decides how you enroll. Search for your county name, followed by the words Property Fraud Alert. Begin with the official website for the county recorder, Register of Deeds, clerk, clerk of court, land records, office, or local equivalent. Confirm the service through that official page before entering personal information. Some participating counties link residents to a vendor portal called Property Fraud Alert. That portal is operated by Fidlar Technologies and is used by local governments that have partnered with the company. It is not a universal federal registry, and its commercial-looking address does not mean every county participates. The county website is your checkpoint. If your official recorder links to a vendor, follow that link. If the search result appears without confirmation from the local government, go back to the county page and verify it there. Enrollment may ask for the recorded owner name, contact information, and a preferred notification method. Another county may support a parcel number or property address. Follow the form actually provided by the office holding your land records, because the alert can only match the fields that local system indexes. A jointly owned home creates more names that may appear in a document. A property held under a trust or business entity may be indexed under that recorded name rather than your everyday personal name. Some systems allow multiple registrations and spelling variations. Others impose limits or use different matching rules. Do not improvise a universal formula. Read the county's instructions and enroll the owner names, entities, parcels, or variations that the office says its system can monitor. If anything is unclear, contact the recorder using the telephone number published on the official county site. That entire process can take about 5 minutes where online enrollment is available. Hillsborough County describes its own registration as taking only a couple of minutes. Other counties may require account verification, a telephone registration, or a paper form. The word free also needs a border around it. Many counties offer the service without charge. Florida clerks are required by state law to provide a free recording notification service, and Illinois law now requires counties to maintain a property fraud alert system. Other states leave the decision to local offices. Some counties may charge, use a differently named program, provide notification only by mail, or offer no automated service. A property in one county will not normally be monitored because you registered a different property somewhere else. Owners with homes, vacant land, or rentals in multiple counties may need separate enrollment in each jurisdiction. If your county does not offer a free alert, ask the official recording office whether it has a property watch, recording notification, land notification, or owner alert program under another name. Some assessor or appraisal offices provide related notices. If no automated option exists, use the official public records search and create a recurring calendar reminder to review the property's record. That takes more effort than an alert, but it attacks the same variable, time to discovery. When a notification arrives, do not assume every match is an emergency. Open the county's official record system through the county site rather than trusting an unexpected link. Compare the property, parties, document type, recording date, and instrument information. If the filing is familiar, the alert has done its job and required a few minutes of verification. If it is unfamiliar, contact the recording office using independently verified contact information and follow that office's stated fraud response instructions promptly. Depending on the document and jurisdiction, appropriate channels may include local law enforcement, a real estate attorney, the title company connected to an existing owner's policy, or a current lender. The FBI also directs victims of internet-enabled real estate fraud to its Internet Crime Complaint Center. The recorder may help you obtain a copy and explain the office's administrative procedures. It generally cannot decide your ownership dispute or give legal advice. That boundary can feel maddening when the false document is sitting in the recorder's own system, but legal validity is a question for the procedures and courts authorized to resolve it. Hillsborough County's guidance tells suspicious alert recipients to inspect the filed document, contact law enforcement when they determine it is fraudulent, preserve relevant evidence, and consider a real estate attorney. Its local process can also involve a notice of disputed title. Another state may use different documents and remedies, which is why copying a Florida response form for a house in Oregon would be an impressively efficient way to create a second paperwork problem. By the way, subscribing helps me keep reading recorder guides and actuarial claim reports that normal people reasonably avoid, so thank you if you have already done it. Now run the forged quitclaim deed through 2 timelines. In the unalerted timeline, the recorder accepts and indexes the document because it appears to meet the jurisdiction's formal requirements. The lawful owner receives no automatic signal. The house looks the same, the keys work, and there is no mortgage statement to reveal an unexpected change. The filing sits undiscovered. A fraudster may attempt to list the property, approach a lender, create a lease, or add more documents. A buyer, tenant, broker, or lender may eventually detect inconsistencies, but the owner has surrendered the first move without knowing it. Discovery may come from a missing tax notice, a utility change, a neighbor, a title search during an attempted sale, unfamiliar mail, construction activity, or a demand connected to a transaction the owner never authorized. By then, the original deed may no longer be the only document in the dispute. In the alerted timeline, the same forged deed reaches the same recording office and enters the same public record. The alert does not bounce it away. The difference appears after recording. The matching name or parcel triggers a message according to the county's delivery schedule. The owner inspects the record, recognizes the signature or transaction as unauthorized, and begins the local response while the filing is recent. That does not guarantee the fraudster fails. It does not guarantee the owner avoids litigation, legal expense, or months of delay. The Bilby case proves how difficult restoration can remain even when notification arrives within 48 hours. It changes the period during which the document can operate without challenge. The fraudster's uncontested window is no longer determined by luck, a neighbor noticing something, or the owner deciding to search county records on a random Tuesday. This is a psychology of money problem, disguised as property law. Paying off the mortgage creates relief, and relief lowers attention. You stop checking loan statements because the absence of statements is the reward. The brain closes the file at the exact moment the county file becomes the remaining place where ownership activity can appear. The financial industry trains you to watch stock prices because they move every second. Your house can represent a larger share of your net worth, yet its public record may go unexamined for years. Cotality's latest average borrower equity figure is $310,500. A paid-off owner's actual equity could be far lower or far higher, and it remains illiquid unless the home is sold or borrowed against. Still, using the earlier $295,000 benchmark gives you a clean comparison. $11,800 a year at a 4% reference rate. You would not leave an investment account of that size without login alerts because the money is not moving today. You would not accept a brokerage system that changed the registered owner and waited for you to notice during retirement. A county property alert applies the same basic habit to the asset recorded somewhere other than your brokerage. It does not reduce liquidity. It creates no market risk. It requires no prediction about rates, inflation, or home prices. Where the county offers it free, the financial cost is zero. Lazy investing built more fortune than crypto memes. But being lazy with investing means removing unnecessary decisions, not ignoring the document that identifies who appears to own the largest asset in your portfolio. Your final mortgage payment remains a victory. The debt is gone, the lien is released, and the equity stays exactly where it was. Now make sure the county record cannot change quietly while your brain is busy celebrating. Change quietly while your brain is busy celebrating.